Marty, thank you very much. It's an honor to be here. I know you've assembled these kind of gatherings and conferences before, so once again, thank you and great job, sponsoring and hosting. This panel is on alternative real estate, so I'd like to kick it off by just going through a round of introductions with the panelists here. I'm actually Ajai Thomas, Trevally Capital Management. We are an emerging manager in the alternative investment management space. Our focus area is all things mortgage related. So whether that includes, mortgage secondary trading, servicing, structuring, we have the expertise. So the first part of Trevally is the team and the deep expertise in the mortgage space that the team brings to the table. The second part of it is the focus on our first, product that we're launching. We're actually partnered with Raptor Group, which is Jim Pallotta's family office. For those of you who may not know, Jim is actually the former vice chairman at Tudor. He's the former owner of the Boston Celtics and AC Roma. And he's made a lot of investments in the past in this space, two of which are pretty notable. One is Two Sigma, when Two Sigma was first starting out, and the second one being Graham Capital when they were first starting out. So Jim has taken a bet on us because he sees the value in the team and the expertise that we bring to the table away from just looking at things like hard assets and buildings. So this is a different viewpoint into real estate and the ability to diversify your assets if you're looking to go into real estate. The third component, Trevally, is the risk management as well that we bring to the table for not only producing low teens type of net returns that are scalable, but also capital preservation, right? How do we not lose money? And the way we do that is by our risk management program. So that's Trevally Capital in a nutshell. The co-CEO, Matt Jazoff, he's in the back, so feel free to say hello to him and engage him. But just to kick it off, I have here with me today Aaron MANOUCHERI from MANOUCHERI Brothers, Ryan Hanofee from Morgan Lewis, Nancy Lashine from Park Madison Partners, Stephen Shipp from Performance Advisory Group, and Salman Khan from Stabilis. So this is Salman Khan, the manager, not the actor. So Nancy, why don't you start as being the female of the group?
Because I can start. Good afternoon, everybody. Thanks so much for really an honor to be here, as you said. So Park Madison Partners is a real estate placement agent. We are just in the real estate space. We raise private equity capital. We bring institutional investors to our clients. I have been in the business for north of 3 decades. I'll tell you, I think all of us here are in the real estate business because we love the business, and real estate is real and it's fun, and it's, despite the fact that if you heard Peter Lewis this morning, data really is the operative factor. If you had to sum it up in one word that's changing the real estate business, it's really about people. So as I was checking in this morning, I was kind of having fun walking into this business because Park Madison Partners, when I started it 18 years ago, is named after the Park Madison coffee shop, which was my father's business. And it was half a block away on 40th Street between Park and Madison. And I remember clearly when this building went up, 101 Park, and it was like the glamour building in the neighborhood. And I was thinking, yeah, Calico built it. Calico, what was his first name? What was his first name? And the security guard, as I'm checking in, goes, "Good morning, Peter." And he went, "Peter Calico." So there he was, the developer of the building. So it's a fun business. What we do is we cover about over 3,000 institutional investors, family offices to sovereigns and pension funds and everything in between. And we have about 150 new business meetings a year for fund product, and another 150 or more for what we call all other structures, joint ventures, recaps, continuation vehicles, everything that's not a traditional fund. We do 2 or 3 of them. So our job really is to be our investors' job as the incredibly steep funnel. We do deep due diligence. We put the material together so that our investors can then understand it in a 30 or 60-minute meeting. We've been doing it for a very long time, and we've raised $27 billion in equity capital. I'm not sure if I said that yet. We've done 14 first-time funds. If you look at our website, you can see we do a lot of repeat business with our clients. Some are now household names, some are not. I would say, and then we'll talk about what's going on in the market today. It's been a really interesting time. This year, the two funds that we did take on, one is data centers and one is in the hospitality space, taking advantage of some of the distress, capital markets distress in hospitality. And then on the other side, we're focused on cold storage, build to rent, and industrial, and iOS. We've done a lot of iOS stuff there.
Great. Thank you, Nancy. Salman, do you want to go ahead and do a quick intro?
Sure. I'm Salman Khan. I'm the founder, CEO, and CIO of Stabilis Capital. I've been in the financial services industry for over 32 years, a third of that at Goldman Sachs. I started Stabilis 14 years ago, so a little more than a third of that at Stabilis. And in the middle, I worked for a hedge fund, which is a credit-focused hedge fund run by Goldman Partners, Silver Point Capital. They're more in corporate, and I ran the real estate investing business for them. So I kind of will echo a lot of things we've heard today. We are finding this opportunity to be remarkable in terms of being able to put capital to work. Our focus is on senior secured real estate lending. So we're first lien lenders, but we make equity-like returns. And then one question as we were prepping for the panel was, hey, you guys, I mean, all these people made all these and we heard from the multifamily manager, everybody, money was cheap and people invested a lot of money in 2010, 2011, 2012, 21, 20, 21, 22. Well, our 2020 vintage is fully resolved and distributed to investors. 2021 vintage is fully resolved and distributed to investors. And 22 vintage has 13 million of capital left. We're a bridge lender, we mean it. We lend on the short term and we return capital to investors with 12 to 15% net returns. And that's what we've done on our last two funds where we've been exclusively focusing on bridge lending. And I'm actually in Peter Lewis's camp. So I've been doing this for a long time. We tried to do it the hard way with people. We've really become tech-enabled. I fired my entire origination staff. We have 30,000 people that we touch. And most of the deal flow is coming through a database that we've developed and we've then scored. And then the noise is out of the system. The deals are coming directly into the underwriting team. They're being filtered by a tech-enabled model. And that is when the humans come in and we do all the work that we've always done in our lives. But the noise in the system of originators, hey, I really like this deal, and underwriters wasting time on things we're never going to do, has been largely eliminated. And then our technology piece has been augmented by real-time technology. I mean, the amount of information you get on cell phone data and on like, okay, here's a strip mall. Should we look at it from a lending perspective? No, because it's never gonna, because the anchor tenant has the worst sales of any of the sales of any of that brand anywhere in the US. And that data you can get, which before was really not available. So that's us in a nutshell. We're looking to raise 100 million of capital. Chip Perkins is here. We've hired him to help us do that. We had 270 million in AUM. We have a money center bank as our anchor client. I've been doing this for a long time, but we are capital constrained. The opportunities exceed the capital base right now.
Salman, thank you very much. Aaron, why don't we go to you, and then Stephen will switch over to you on video.
MANOUCHERI with MANOUCHERI Brothers, as well as Universe Holdings. Thank you, Marty, for the invitation. Appreciate it. It's an honor to be here. We are essentially an owner-operator family office in the business. I'm the third generation, one of 8 kids now, with 3 of the boys in the business between California, New Jersey, Florida, and the Middle East. My family originates from Iran as well as Italy. Left in the 1970s when the Shah was exiled. That's when we pretty much exited and got out and started essentially over here in the US markets. We specialize in value add apartment buildings, deals anywhere from 100 units to 1,000 units per transaction. We have a little over 2 billion in AUM and privately held assets in the family. We buy these properties on our own alongside other family offices via JVs and select opportunities. I grew up in the office pushing paper at 6 years old for $1.50 an hour. At 4 a.m. in the morning was kind of a great day. My dad is a real leader. He's a man who's been through a lot. This is the energy that runs the firm today. The reason we expanded out of California, I grew up in LA in Beverly Hills, is a lot has changed in the past 5 years, to say the least, in the world and in politics, and especially the impact on landlords, which is us and I'm sure a few others in this room. California is an incredible place. We still find some markets there, but as an example, recently mansion tax was passed on multifamily to help with the homeless crisis. Instead of creating maybe, as Stephen said earlier, maybe some more mobile home parks or affordable taxing components or different ways to do it, but taking from those that have built businesses from the sweat of their brow and essentially handing it out to those under the 405 freeways in LA. So when we saw this happen during COVID, the eviction moratorium was born. We took it personally, and I sat around the table with my brothers and a couple of my cousins at the table, and I said, "We're saying Farsi Baba," which is an honorable way of saying father. I said, "Enough is enough. We're going to essentially pivot to capitalize on migration trends that are happening right now, and to further protect the family and our other family offices that invest alongside us." So we moved to Bell Harbor, two brothers there. I'm on Long Island, divide my time between the two places. Since then, thank God, we've purchased a few $100 million in AUM of truly multifamily at far below replacement costs. The way we do that today is we get the phone calls. We don't have to go out. Brokers call us direct and enable us to have a preliminary view of the assets before they go to market, which definitely helps. George Marcus is a family friend of Essex Properties. You can look him up. That's like Marcus and Millichap, Walker and Dunlop, and a few others. But in short, I think that today, all of us here, there's great opportunity out there. And we'll touch on this shortly, but to summarize, the Fed funds rate moved 11 times since the height of COVID. And that's put all of us in this room in a great position. If you have cash to buy distressed properties. And we were pitched deals in our family that had the capital stack didn't make any sense. There were bridge loans up to 90%. I had these investors trying to convince me, my brothers and my father, go bridge to HUD, to going in cap of 2.6, and the loan is 3%, and I have a rate cap for 1 year at a 2% strike. I literally threw them out of the office. The business that requires discipline and principles. And that's something we never compromise on. So thank you for having me. I hope we can get into the trenches on what we're discussing here.
Aaron, thank you very much. Steve, why don't we switch it over to you?
Great, AJ, thank you. It's a pleasure to be with you all. I wish I could be back there in New York, but dialing in from California, which is essentially on fire. I look at my window and I see a 10,000 acre blaze literally across the freeway. So I'm the CEO, CIO, and CRO of Performance Advisory Group. We are exclusively focused on distressed real estate. I started my career in commercial real estate 30 years ago as a very young vice president with Bank of America, eventually going on to run all of their workout groups, the commercial mortgage workout groups across the country. I've taken that career and expanded it. I've been the CEO and CRO and CIO of multi-billion-dollar portfolios. Today, what we're primarily focused on is, again, strictly distressed commercial real estate, largely because we think that's where the biggest opportunity lies today, especially in certain asset classes such as multifamily. So primarily focused on providing advisory services for our clients. We work with banks, we work with hedge funds, private equity, and individual investors who find themselves in a distressed situation, whether it's an issue with the debt. Well, it's primarily an issue with the debt, as most of you know these days. So we are actively involved in restructuring the debt. We know that space extremely well. Having been the CEO of a special servicing group and a bank executives, we speak the language. We know their governance. We know what their algorithms look like. So we've got a pretty positive track record, especially in this cycle. But we also invest. Look, we're investing in distressed assets that are available at far below replacement cost. And those elements of distress could be an issue of capitalization, could be an issue of debt. It doesn't really matter. Frankly, from our perspective, the bigger the challenges, the better the opportunity. And then, of course, being that I am so near and dear to this challenged real estate issue, we also speak on the subject, and we teach and we train on the subject. So we do one speech called Pivot and Profit, which is really what the world is faced with these days, especially in the real estate arena. The notion of pivoting and capitalizing on these, what could be once in a generation opportunity. We're deeply vested in that. So, yeah, thank you, Ajai.
Thanks, Stephen. And last but not least, Ryan, do you want to give a quick intro?
Sure. Hi, everybody. And of course, we save the lawyer for last. Hi, my name is Ryan Hanofee. I'm a partner here in the real estate group at Morgan Lewis. I split my time between Boston, which is where I reside, in New York, where I spend 1 or 2 weeks each month. I represent a lot of folks like yourselves that are institutional investors, family offices. I also represent a lot of developers and sponsors on deals. So, and I'll work at kind of the property level on real estate transactions. So I'll do the acquisition documents, I do the sales, I'll do leasing. I do a ton of joint ventures, both between the equity partner on the equity side and on the sponsor side as well. And then I do the financing work for folks that are doing construction loans or doing mortgage loans and refinances. It's certainly a pleasure to be here today. I'm very interested to hear everyone's experiences and what the future is going to hold in real estate. I think the last 2 years has been tremendously slow in my world, kind of in the direct investment space. But I know a lot of people have cash that are sitting on the sidelines. And my experience over the last 2 years has been with a lot of both investors and developers and sponsors saying, where can I find that perfect deal? Who can you put me in touch with in order to, do something right now, because of how slow things have been. But I think within the last month, 2 months, I've signed more contracts and done more deals than I have in the last 2 years. So I think the future is certainly bright, and obviously we're going to talk about what each of us are experiencing in our own worlds. But it's been, I think, yeah, I guess it's going to be a busy 2 years in the real estate industry. Question?
Sure. I happened to read the end of the month, August, interesting article that came out of Bloomberg, and the partial title was Real Estate Maturity Wall. Let me get some of the facts here for you. That world face a $1.5 trillion maturity wall of loans next year, 2025, which may be unfinanced. A lot of problems with high interest rates, insurance costs, apartment buildings, etc. A lot of multifamily walls underwater. So how do we get away from trading away? What do we do?
I was going to say we do have some Q&A, but we could answer that. I think it's a good topic. So
I mean,
So,
Are these stats real?
yes, I mean, depending on the one you're looking at, I read one from KKR, which was 1.1 trillion. Now, relative to our world, 250 billion is what's on my mind. That's a multifamily. And yeah, you're spot on. Relative to what Ryan just said, the most volume we've had since maybe the height of the real estate market. This is what's happening as we speak, and it's not really being publicized, except maybe Brookfield and Blackstone just went on a buying spree. But we're very close to a few families, a couple of them are in this room right now, who quietly are going on a buying spree. The reason being is because where the job loss market report just came out, I think it's 116 and 144 versus the regular 200K plus. The 10-year and the 5-year T-bills plummeted. And it's pretty much putting the Fed in a position to cut rates. The question is 25 basis points or 50. You can have that conversation. But once they do that, cap rates by default will be compressed. basically tighten up. And that's why right now, quietly, there are many family offices, owner operators that I know, friends of mine. We go to the same club or the same synagogue, and they're literally flying away. And what they're sourcing is very similar to what we're looking at, distressed deals. We've had many syndicate models. I just sat with one in Manhattan Beach, a gentleman who bought close to 4,000 units in the span of 2.5 years across the state of Florida. And I'm sitting with him, my brothers and I, moving, shaking like this. Now, if you trying to show confidence, you're not bouncing around. You hold the table. This gentleman was crossing his legs and he was, just moving all over the place. I said, "Tell me what your capital stack is." He said, "Well, we only put in 5%. And we're using, roughly 85% LTV. And we've been doing this by way of JVs with larger private equity groups. And I'm signing on the loans." It really didn't sound like he had much of an education, but rather he was running a fee machine. He was tying up these deals, 800 units, 600 units, 700 units throughout the state of Florida, as one example. And today, he's essentially wiping out his investors by recapping these deals or extending his rate caps, which costs, depending on the loan size, and Stephen could probably touch upon this, 1.5 to 2 million per cap. And he has 24 deals. This man alone, 24 deals coming due Q4 2024. So the numbers are real. And if someone is liquid today, be ready. The time has been the past few months, because once they cut rates, everyone in this room is going to pounce on those opportunities. Like my grandparents. The floor is going to be open. So that's my point from what we're seeing. I'd love to hear what everyone else has to say.
Yeah, I'm happy to give, a slightly different perspective. So my career has spanned through 4 deep cycles, starting with the 89, the SNL crisis. And if you look back to private equity business, it didn't really exist then. It sort of started then. That was the beginning. In fact, we created one of the first funds. If you look back to the Great Financial Crisis, so 15 years ago, there is more dry powder today that's been raised but not invested. So committed capital, not invested capital, $400 billion. That's a global number. Than the entire market was 15 years ago. So yes, there are absolutely some really, some people who were well over their skis, but there's so much more capital in the market today. And the big trade that we're seeing, and where most of the institutional players are playing, is the gap equity. So if you go back through your analysis and you say, what will it take to refinance those loans? The properties are fine operating wise. They were just overcapitalized. So you've got gap equity, and the lenders will at some point get to the point of saying, I'll extend your loan, but you have to put in another $20 million of equity. If a developer or owner doesn't have it, they're going to the private equity world, most of the asset management firms. So the big trade over the last year or two has been mezz debt, structured finance, and you can do that at 15 to 18%. Nice coupon, big upside, but it's 2 to 3 years, and then what? So I think and we could spend the whole time going through this math. If you take office out of the equation, that's the big piece. If you take office out of the equation, which is now in institutional portfolios using NCREIF, the index for institutional real estate, it's now 10%, just down from like 50 or 60% 25 years ago. If you take that out, the problem really isn't all that big. So yes, there are great opportunities, and on the margin, people will make great deals and lots of money. But bigger picture, it's definitely, the bottom is behind us, is the broad view. For most institutions are now saying, okay, we've seen the bottom, but because the future is so murky, nobody really gets comfortable. If you look at a 20-year trend line, where are interest rates going to end up? The 5-year is 3, the 10-year is 3.8. And in my world, we price real estate off the 10-year, right? You may price it off a lower rate because you want some good news money, or you want some, you don't want to you want to sell it within 4 to 5 years because it's a value add strategy. But if you look at 3.8, that's a pretty good number. And that means you can today buy real estate pretty soon, 150, 200 basis points over is your mortgage rate. You're going to be buying it neutral to positive very soon, and certainly with one rate cut. So the bottom's probably behind us, but the future is really complicated to see because of tech. Yeah.
When the Corey is like to defend with SVP.
Yeah.
Okay, and look around, you realize that basically 70% of most regional banks portfolio is commercial real estate. And those kinds of lending at 3, borrowing at 7, you can't make that up on volume. What is that overhang? Is there a part of that that works into your equation? Think about this process.
Yeah, go ahead. sorry.
So I mean, I have the statistics. It's actually not that bad. So if you, and the largest 10 banks, which are the largest banks, actually have the highest non-performing loan ratios. I was a former distressed guy, so I used to look at that all the time. So for example, my ex-employer is at 8.5% non-performing loan ratio on its commercial real estate book. So that means they have a big problem in their CRE book, but it's only 10% of capital.
I'm talking about the 70% of regional banks in East nowhere.
In terms of the regional banks, their number is 40 basis points of non-performing loans. So there isn't a real estate issue that we can see or else they're lying, which is, I don't think so, because they're pretty heavily regulated. They do have an issue that because about 300%, 260%, and we look at banks, our competition is 2 to 100 billion because that's who we compete with in terms of investing money. Those banks have a ratio of 262% of real estate loans to capital. The Fed's care at about 300%. So they've already punished the guys that were higher. So Flagstar was at 462, it's gone, right? Signature is gone.
But so much of that issue too was confidence, right? Had they not lost their deposit base, they would have been able to wait it out. And what you're seeing today in the banking world is you can't get a loan if you're a developer or owner without putting down deposits. So the banks have gotten savvy on that and they're building up their deposit base.
Stephen, do you have any insight into this?
Yeah, I actually do. As a previous banker, I understand how they manage their risk and how they manage their portfolio. I can tell you empirically that the vast majority of the regional banks that I have worked with have not set aside nearly enough capital to cover their probable losses, which implies that their special assets groups are probably understaffed because they're not today risk rating their loans consistent with the underlying value of the asset nor the probability of repayment. I can't say empirically that's true for all regional banks, but for the dozen regional banks that I've worked with, it's shocking how little cash they have or reserves have been set aside to cover losses. Now, I will tell you, there's a massive bifurcation between regional banks and some of the larger national footprint banks. Those national banks have learned and retained the lessons from the last downturns. They have done an extraordinary job of lending to tier 1 borrowers with plenty of equity in the deal, with a solid business plan. And so I am not particularly concerned about the Bank of America, the Wells Fargo, the Chase. They have done an extraordinary job in their loan origination and their asset management practice. But the regional banks is a completely different story, in my opinion.
And my experience has been similar on the regional bank front. In Boston, I have contacts with several regional banks, and they haven't done a deal in the last 2 years because their deposits are so low. So the plan is, let's wait it out. But I know for a fact that they're looking for ways that they haven't done previously in order to sell the mortgage loan, or bring out, or force the borrower who may be in default to sell at a discount.
Why are you not hedging your bets or hedging your investments to offset potential risk? In any situation, when you're investing money, you always should be analyzing what your risk is and how you're offsetting it with an offset to that risk, hedging that risk in some other form of investment. So when you have one going up, the other one will offset that going down, so to speak, or the other way around.
Aaron, as a direct investor, how would you handle the hedging?
I'll say like this, and going back to my introduction, not compromising on principles. When all of these deals were going around in Texas and Austin, San Antonio, even Boise, Idaho. I've never heard of Boise, Idaho. Blew up. I got a deal. I'm like, what is this? This is Idaho? It just comes down to the essentials, the demographics, the employers, the migration trends. Is this deal sustainable? Can these tenants actually afford a $300 increase? How much are they earning? What's the rent to income ratio? How did this market respond during '08? What happened prior to that? We use data, AI and forms of it via Axiometrics and CoStar, a few other programs. I personally will have one of my siblings drive the comps, verify the comps, act as a tenant, go to the building. I want to see the renovations that they did, take pictures. Who are the tenants? Where do they work? I'll tell you what's happening right now. The job loss reports are real. We do own a segment of workforce housing. And more than ever before, we've seen an influx of forged pay stubs, fake pay stubs. So when you're looking at a market, you really have to understand if it's sustainable. And the whole COVID rental growth of 20 to 30% is not. It's recorrected, but thank God the deals that we did were all 10-year money, minimal leverage, nothing fancy. I'm not trying to go bridge to HUD and move this way and move that way. We push the rents, we refinance out our capital, return it, hold on to the asset for long-term cash flow. And that's essentially our model. Each person here has a different mentality. But when you ask that question, for a moment, I breathe and I'm relaxed because we're not in that position. In fact, we're excited to deploy now based on those who compromised on their principles or thought they could have, make shortcuts in multifamily. Every sector is different, but I guess that's what's coming to mind.
I think you're approaching it correctly. Stage on this, but my attitude is if I'm running a company, I always consider a company a work in progress. If I'm not protecting against all the risks associated with that work in progress, something wrong with me.
Right.
So in our case, I mean, you are a long fund, and we have, and you have basis risk in trying to hedge. And frankly, I have tried to look at it, but the way to solve for that is to say, okay, let's cast the widest net possible and see everything. And then be able to say no consistently, to be able to put money out on a very small basis. So I was talking about tech-enabled. We started lending money 7 years ago. We were initially doing rescue capital, but we've touched 30,000 people. We know exactly who's sending us deals. We've then taken that and put it into a database and scored everybody. And we used AI to do that. I don't know how Salesforce does it, but I wrote the algorithm to score every interaction. So now over 7 years, I know somebody has a 2,000 score, send me 15 deals. The deal comes in from him. My entire team is focused on it. After that, it's another, like I've basically tried to take 360 deals that we've done full round trips on and said, okay, it's not AI-able yet because my brain is still more powerful, I think, and my team's brain is still more powerful than AI. But we've created a decision tree model that says, okay, if a priori knew 4 or 5 data points, could I have predicted this deal better? And every deal we have goes through that. And it's a direct API into the BLS system where we get like simple data points, but on a census tract basis. So that's like a 5,000 population center census tract. So that says, okay, look at it more. And then it is by property type, right? We don't do office, we don't do construction deals, we don't do development deals, we don't do land deals. I mean, they're all longer dated deals than what a 2-year maximum is allowed.
What I'm looking at, saying to you, you're doing that, you're evaluating the portfolio and structuring it to mitigate risk. I'm talking about, let's say, set up credit default swaps as an insurance against the risk.
No,
As an example.
yeah.
That's
And you think about it if you're worried about catastrophic risk, and we have. Like, I mean, I was actually not even part of the long short, but I was long a portfolio of residential mortgages because I was like, I was living in the 2000s and saying, okay, I own this portfolio of resis, but the bonds are trading at 95 and it's the easiest hedge on the planet. Well, the portfolio lost 10%. It was a $300 million portfolio. I bought 30 million in bonds and they've all went to zero. So, but you can't hedge right now. The hedges are very expensive.
You can hedge. It's done with Fannie and Freddie. You have to hedge. Like banks are requiring until you have to hedge. You got to hedge or else you become an SPV. Right? That was just pure negligence.
Nancy, do you have a view on this? Just looking at it from a very top line across many
Have
different
you managed
clients.
risk in real estate?
Across
Well,
clients. across
yeah, I mean,
various-
well, look, real estate is the biggest asset class, right? So it is, there are so many different ways that people look at real estate that it's hard to talk about it in one generalization. We have clients who look at real estate as a risk mitigator in their portfolio, because it's pretty darn easy to analyze the risk in the building, right? What's the value of that location? What's the value of this lease? How are you capitalizing it? Maybe it's all equity, so you don't have any interest rate default risk. Yes, you have to manage your expenses. Yes, you have to manage what's going to happen with taxes, but those are all very understandable, business risks. So you can have a core real estate portfolio. It will generate your actuarial assumption as a pension fund, call it 8%, 9%, if you want some real return, with minimal risk over a long period of time. And that has been the mantra for the last 40 years since ERISA for many, many pension plans. Do you get it wrong? Absolutely. What was the 100% location in New York City? Well, I would contend it's 2 blocks from here, Grand Central, right? Now, you might say at certain points in time, the 1970s, and maybe, during COVID, that wasn't such a great place to be. But again, if your perspective is long, that feels pretty comfortable. You might have the same issue with respect to San Francisco today, and that would be a judgment call.
Speaking of San Fran, Stephen, do you have a view on this?
On what, San Francisco?
The hedging, actually. How
Not
would
on the-
you look at
Well,
hedging in
look, I
terms
mean,
of?
the hedging is such a challenging question today. One, it's super expensive. And two, what are you hedging against? My general perspective is that while some people are calling a bottom, we're not even officially in a recession yet. And there's been very, very limited forced selling of any asset class, whether it's equities, commercial real estate. Until forced selling occurs and there is some element of capitulation, we're not going to see the bottom. And so I'm, inning 3. And so what does that hedge look like? I really don't know, because I'm not an investor today. Or if I am an
Stephen,
investor.
if I can add to your point, for, I guess, those other sponsors and owner operators in the business, a lot of these deals are not being publicized. They are maybe
true.
a month or two after. We've gotten a couple calls recently of deals that are belly up to do a cash infusion and pretty much replace the GP. So it is happening. You're right. I don't think that, there's as much blood on the streets as there could be, and there will be. But a lot of this is happening behind the scenes. And in terms of hedging, there's one track we have, or one bucket within our firm, which is long-term loan assumptions as a hedge against anything. There's one particular portfolio that we bought recently in May. We bought about 7 buildings in the Fort Lauderdale MSA. Took us a year and 3 months to find this deal, but it was a 9-year note with Fannie Mae at 4.7%, with 9 years interest only and only 57% leverage. That to me is a beautiful story, assuming your cap rate is far above that, which it was. It was over a 6, which I'm now taking to 9.4 as we speak. And on top of that, our teams are all vertically integrated. Construction is in-house. Management is in-house. Materials are in-house, depending on how far we go. But when you have complete control over your business and every angle of it, and it's you and God, and the other metrics that you rely on in terms of demographics, you can do very well right now. I just don't know how much of it is being publicized.
You had a question.
Quick nuance on this article. Just a very quick comment. Apartment buildings make up 40% of the insurance. Turns out that a lot of these people finance apartment 3 or 4 rate notes, and a lot of them roll the $80 billion worth of commercial CLOs. Any issues with banks on some of the marketplace, the CMBS and CLOs and things like that? You got a thought or what's going on?
I've been studying this market on and off. I've been a CMBS bond trader in periods of distress. I think the CLO market is definitely. They were the lender of last resort as you were going to those metrics that people are talking about, where it's like cap rate's 2.6%, LTV we're going to go up to 85%. We didn't do that, right? I mean, we are a short-term lender, but our basic analysis is, I don't care. I'm not going to lend on anything less than an 8 or 9% debt yield, even when the markets were that attractive. So I think that it's a real issue, but similar to the GFR, it's going to be concentrated with investors. Because who owns the CLOs? AAAs are owned by insurance companies, and then as you go down the stack, it's owned by investors. And some is owned by the issuer. So it's not a bank issue, but these guys are in trouble.
About 10 minutes to go.
Great. You're looking ahead, going into an election year, looking at a Fed cycle and many other kind of economic challenges that are on the horizon. You know, in 2025, if you guys were to look ahead, what is your best idea that you would dangle as a carrot in front of the audience, just to show how you think, what you're looking at, and where you would invest?
I mean, I really liked what the first speaker said this morning. It's like I have given up procrastinating on the market direction. Look at data right now. Short term is long term. Look at stuff and be very true to your principles. Look for debt yield. Look for cash flowing assets. And that is our defensive view right now. It's like in the middle of COVID, I made a loan to a very large family office that was buying assets at 35 cents on replacement cost. It was a hotel. I was the first lender to hotels in the middle of COVID. He did extremely well. Today, I will not do that trade because you shouldn't be able to buy a closed hotel at 35 cents. I don't believe the number. So today it is cash flow, cash flow, cash flow. If I don't have a debt yield, I'm not doing it. I really don't care what happens next year, because at the end of the day, I'm in a short-term business, and as long as the property is cash flowing, the trends are for us and will remain cash flowing. If cap rates go down, they go up, I'm at an LTV. So to answer your question, part of my hedge is my margin of safety because I'm a senior lender. I don't do mezz, I don't do equity. So real estate would have to drop by 25 to 35% for us to be impaired on our capital. Can it happen? Yes, but I mean, I don't see any. If the scenario is not that, I'm not worried about it. So I think it's like, okay, short term, find the best deals, cast as wide a net, take advantage of the distress. The more uncertainty there is, the more volume will come our way, and we can sift through and be very, very disciplined in deploying capital.
Aaron, what about you?
Sure. I'd say that I'm very happy we're in multifamily. I think we're 3 million homes short today, a 30-year fixed mortgage that seems to be very steady in the sevens. We have inflation. We still have cost of materials, labor, everything is up. And the first one to feel this is your blue collar workers. And my hedge, or my strategy moving forward, is to simply replicate what we've been doing all these years for 60+ years. And that's just buying bread and butter multifamily apartment buildings in top tier gentrifying markets that have, the essential components there. I don't need to reinvent the wheel. It's all there in front of you. You find a place that is seeing tremendous job growth. I'll give you an example. The LA Rams, they play in the SoFi Stadium next to LAX. We bought there over 10 years ago, way before it went up. And we own around 15 properties all around the stadium. There's now the LA Clippers there. It's a $10 billion infrastructure. If you ever fly over LAX, we took rents from roughly $1,000 and change to about $2,500 or so over the span of time by refabbing the entire building inside out. A new tenant demographic moved in. We took the other tenants, moved them to our other properties. So it was a win-win. This isn't, rocket science. It's very simple. Don't compromise on your principles. Find a deal that makes sense. Make sure your cap rate makes sense in terms of where you're borrowing at, and simply don't compromise. But assuming you're in a position where you have cash right now, and I think the next bit of time, there are some great opportunities in front of us. And that's why I don't see this as something I'm overexcited about. We're simply continuing to do what we've been doing for a very long time.
Aaron, is that area an opportunity zone?
We own it, yeah. Are you talking about, yeah, that is, yeah. Certain different, depends on the, by block. Yeah, it's absolutely.
Samir, did you have a question?
So more multifamily questions. Past few months I've seen lots of stories about indicators and how the investors have gotten screwed by that. Is that a pipeline of distress opportunities?
Absolutely. That's what I meant earlier by cash infusions. We have many friends that have called us directly, deals that are not publicized where we simply took over. There are many stories of capital calls happening right and left right now across multifamily, which has really shied away many investors. And the opportunities there are essentially to come in, remove the GP at a discount, take over the portfolio and run it next to your other properties. It depends who you are and where you own, but what you speak of is real. It's very real.
How easy is it to find these syndications? I mean, we've seen dozens of them.
You could start by going to the Real Deal and type in what you just said. You'll see a few names come up. I've sat with all of them.
No, I mean, we've been living it,
Yeah.
right? So many people came to us the last 3
Yeah.
years with syndications that were awful.
I've started by to Marty's point, I've reached out to our banks directly. I said, hey, we're here. We're ready to pounce. I've even received a call from one of our partners out of Toronto. He's like, MANOUCHERI, I have 300 million. Go. I'm like, yeah, well, it has to make sense. I'm not going anywhere. Be patient. So you have to find the opportunities, underwrite them, do your due diligence. I couldn't say it more. But these deals are definitely out there. But it's depends on the market. Can you elaborate on your question?
How big is, you say, how big is the supply?
How big is, how large did the universe of what the syndicators get? Is there enough capital to replace that?
So yeah, these guys were all around Texas and Florida, especially those states that everyone migrated into during COVID were the most activity of these syndicators that came in out of nowhere. I used to see them at conferences. I've been to many similar conferences, but more focused around real estate. It could be IMN, Karma, many other different platforms where we speak with other owners. But these guys just appeared and disappeared. It's frightening. They would come.
Also tend to have been, as a result,
Yeah.
somewhat overbuilt. So you have to be careful, to Aaron's point, to do your due diligence, because there's, Austin, disaster right now. Florida, lots of markets are a disaster and multi. But I think you asked a great question. And certainly from an institutional perspective, where's the money flowing? 5-6 years ago, it started flowing into industrial, obviously for all e-commerce and the growth of industrial. And it's the last 2-3 years, industrial outdoor storage has been an incredibly hot sector, and cap rates have gone from 9 to, all the way 5 and 6. And there's conferences all about industrial outdoor storage. So that's kind of, it's out there, but it's kind of going. And I'd say, cold storage, anything that's alternative, cold storage. And one of the next really interesting spaces is build to rent, because of this great housing shortage that we had. But more and more people want to live in vertical sort of homes. Basically, it's horizontal multifamily would be the way to describe it, but they're build to rent 2.0, not the scattered site SFR properties. And that's a huge sector of the market that will continue to grow. So there's a lot of niche, and then data centers, which of course is so capital intensive. You don't have to do hyperscale. You can do edge centers and co-locations and networking. That's what we're doing, because it's just more, it's a little more manageable, and it's not just a net lease play, and you don't have to worry about the residual in 10 or 15 years. But that's what institutional investors are thinking about. They're looking at all these different alternatives right now and thinking about, how do we build out the range in our portfolio to get more diversification of tenancy, of cash flow, and also, and I think Peter Lewis did a great job this morning talking about this, to find the alpha, because that's where the growth is.
Great. Thank you, Nancy.
One more point, if I may add, just to add a little more flavor here. When looking in your markets, we try to focus on essentially what we call high barriers to entry. So as an example, the market that we recently expanded into, 80% of the apartment buildings were all 1980s product and prior. So when I think about the incoming new construction, there's only so much of it because you can't just show up and break ground. We're far below replacement costs. And that's really something to look at. And that's why I never personally went to Texas. Austin is going through a major correction right now. But we really look at the state of Florida as an example by zip codes, block to block. The whole thing is not golden. I haven't touched Tallahassee, Gainesville, and Ocala. I think there's many beautiful horses out there, but I don't like land. I like to live on land. I don't want to buy a property that's surrounded by excess land.
Let me ask you a question.
Look at it. If I could jump on that for just a quick second. We have found that through the last 4 cycles that I've been in this business, that it's the markets that don't have the barriers to entry, that you get your permit and your build, which is primarily Nevada, Arizona, Texas, and Florida. They always get overbuilt in every cycle. They always get overvalued. Well, every cycle I've been involved in. And then values crash. And we're starting to see that today. One more point on the whole LPGP thing and the multifamily debacle that was 20 through 22. There is a lot of capital calls, and there have been a lot of capital calls occurring. And for the most part, those are absolute disasters. Throwing good money after bad because of the high leverage nature of most of those deals and in some cases, incompetence of the GPs is just a tragedy. And clearly those that are well-versed, like this panel here, can play a role in stopping that. It's almost grotesque, when you put your life savings into a transaction and now you're being asked to protect that, even though there's in many cases, in most in the multifamily and that time frame, there's no equity to protect. In fact, all you're doing is throwing good money after bad. So there's a lot of that going on today.
Great. With that, Marty's giving us all the hook. So thank you to Marty and thank you to all the panelists.
Hey guys, thank you.